Joined now by Tertia Jacobs, a Treasury Economist at Investec. Tertia, good afternoon to you. 50 basis points, were you as surprised as the rest of us?
The rest of us, the financial markets, there was a very high conviction rate that the Reserve Bank will increase the repo rate by 25 basis points.
I suppose the question then is this the right move? I mean, could it be too much for an economy already struggling, where people are already struggling, or is the bank seeing data in a different way to the rest of us simply because of how high inflation really is?
You know, Stephen, I think your latter point is the key issue. We've been trying to think why the Reserve Bank actually accelerated the pace of increase. We know that incoming data surprised a bit on the upside. Inflation expectations remain more elevated, and the Reserve Bank revised its inflation forecast for this year from 5.4% to 6%. So they must be concerned that there's a broadening of inflationary pressures in the economy.
So much of this is about food price inflation. And I mean, this is where people are really feeling it. A prediction this year that food price inflation will be just under 10% for the year by the end of 2023. That's devastating.
Yes, I think so. To be fair to the Reserve Bank, they previously expected food inflation to average 7.3%. So, with inflation, food inflation hitting 14% in February, they had to revise the inflation forecast higher. But I think what's also playing out there is that the load shedding impact is exerting upward pressure on companies' input costs.
Well, this is the important issue. The Competition Commission wants to have another investigation into the price of basic foods. There's already one into fresh foods. I've seen some commentary from economists who've suggested the Competition Commission may be barking up the wrong tree, that no one's profiteering here. This is just a function of simple economics.
Absolutely. I think one can reason that margins are probably coming under pressure. Transport costs remain elevated. Fertilizer prices remain elevated with the rand depreciating. So, there's broad-based input pressures coming from all areas.
How important is load shedding to all of this? I mean, without load shedding, is it possible to know how different our economy would be right now? I realize that's impossible, but the point is that load shedding is surely a major factor in everything we see right now.
Absolutely, Stephen. The governor mentioned that they're busy looking at the impact of load shedding on inflation, and he guesstimated that the impact of load shedding can add a roughly half a percentage point to inflation. And I think where we see that in the Reserve Bank's inflation forecast, you mentioned the acceleration in the food price inflation forecast, but they also see core goods inflation, so that would be goods excluding food, also rising, and that speaks to the point of a broadening inflation driven by load shedding.
Tertia, the obvious question then becomes what's going to happen next? I mean, the Reserve Bank forecasting growth, economic growth for this year of just 0.2%, which means we're not just moving backwards, we're actually moving backwards quite quickly.
Yes, so this rate hike has definitely pushed monetary policy into restrictive areas, so it's going to have a bigger impact on consumer spending, right? And I think the Reserve Bank's other message which they're trying to convey is, inflation expectations. They're trying to get inflation to return to 4.5%, which can materialize in 2024. But they're trying to control this pass-through effect of higher input costs, because the challenge is, and it's playing out internationally, that inflation appears to be stickier. So that is where, for example, in America, we know that the inflation problem is different to South Africa's. They're trying to rein in demand, and in South Africa, to the extent that demand is still positive, they're also trying to make it very difficult for companies to pass on higher input costs.
There are so many different things to all of this, but it seems that so many of the elements, the things around load shedding are within our control, sort of, but so much of it is outside our control. And inflation is actually higher still in many other countries right now.
Yes, but Stephen, if we just look at the news flow in South Africa, over the past quarter, yes, there are external dynamics, but when you look at the performance of the rand, the rand has underperformed other emerging market currencies as well. So there's definitely a specific factors that are contributing to it. So it is the load shedding. We actually need more urgency on it. We had the grey listing. We had S&P changing its outlook from positive to stable. We have wage increases that's going to be fairly elevated. So the news flow is just not constructive enough.
Tanya, I mean, obviously, Tertia, the point is that, what the Reserve Bank wants to do is to be able to lower interest rates earlier. The earlier you put them up, the lower you will be able to lower them. But if we look at what's happening now, 50 basis points, I mean, it's going to increase, I think, political pressure on the bank that may not technically, strictly be their problem. But the fact is that this is going to be very painful for a lot of people who are already, many of them, battling to survive.
Yes, Stephen, and I think, this is where, the battle against inflation, the tools for it, is very blunt. The Reserve Bank only has interest rates at a disposal, and verbal intervention by being quite hawkish. Yes, so it's a question of, how soon, the economy and demand and inflation will respond to these higher hikes.
And Tertia, I mean, going forward, could there still be scope for more interest rate increases this year? Or do you think such a high hike now may stave that off?
Stephen, that's a very difficult question. I listened to the question and answer session of the Reserve Bank, and the governor sounded very open-ended. So I think going ahead, we obviously watching what's happening internationally, how the Fed is going to react at the FOMC meeting in May. They're monitoring the impact of the banking turbulence, where the credit conditions can start to tighten, which will rein in demand. And then in South Africa, we will monitor then how the outcomes of inflation perform relative to the Reserve Bank's revised forecast. So one would have thought that we're very close to the peak in the interest rate cycle. But the question then is, when you look at the 5 MPC members, 3 of the members voted in favor of 50 basis points, and 2 of the members were in favor of 25 basis points. So can they abruptly switch from a 50 basis point rate hike to 0? Do we need some signaling that they are going to reduce the pace of rate hikes again, or can they just end? So I think from where we're sitting, I think one must leave the option that they can hike again in May.
Tertia Jacobs, thank you. Treasury Economist at Investec. Really appreciate the time.